Hi, good morning, everyone, and thank you so much for joining us here at our mid-year review. My name is 𝗲𝘆𝘀. I'm part of the research team in iFAST, and today the focus of my presentation will be on our portfolio strategy, which has historically been a GDP-weighted methodology. But in recent times, in response to some of the major changes that have taken place in the global landscape, our team has actually taken the decision to transition away from GDP weighting and adopt an entirely new portfolio strategy in our portfolios that we believe is more suited for the current global environment. Which is why I'd like to just take this opportunity today to update everyone on the rationale behind some of these changes inside our portfolios, and also to update everyone on the new strategy that we will be implementing inside our portfolios. Now, for existing clients of our managed portfolios, you may already be familiar with the way we do our portfolio construction. But for those of you who are new to our managed portfolios and are not familiar with our portfolio strategy, our portfolios have historically followed a GDP-weighted methodology. By the way, for those of you who are taking photos of this slide, I just wanted to say that this is our old strategy, which means it's outdated. So later, wait for our new strategy, and then you start taking photos. Okay. So this is our old strategy. I wanted to just explain to everyone, what we used to implement inside our portfolios. So this is called a GDP weighted methodology, where the regional allocations are actually based on the size of the underlying economies. So how do we decide how much to allocate to each equity market? We basically just look at the size of the economy as a percentage of the global economy. So for US, for example, how do we decide how much to allocate to the US? We look at the US economy as the size of global GDP, which is around 25% of global GDP, which is why if you look at our portfolio allocation, our allocation to US equities is around 25%, which is equivalent to the size of the US economy relative to the global GDP. So we do the same for the rest of the other global equity markets, and that also includes China. China features quite heavily inside our portfolios because it is the second largest economy in the world. And in fact, we have about 15% exposure to China. So if you look at this chart over here, we have a standalone 6% allocation to China. And on top of that, we also have quite substantial exposure to China within our Asia ex-Japan allocation. So in total, we have around 15% allocation to China, which is roughly the size of China's economy relative to global GDP. So this is GDP weighting in a nutshell. So this methodology has actually served our clients very well over the years. But the unfortunate thing is that the world that we live in today is significantly different from the one that we lived in 10 to 20 years ago. In recent years, we have been confronted with US-China tensions. We've got the war in Ukraine, and we also have increasing conflict in the Middle East. And all these events have shifted us towards a multipolar world, which is why it has actually prompted us to reevaluate the relevance of our strategy in recent times. And we have also, after much internal discussion and consideration, we have taken the decision to switch away from GDP weighting to a more conventional market cap weighted approach. Now, before I go into the reasons why we are shifting away from GDP weighting, I just wanted to share with everyone some of the reasons why we even adopted GDP weighting in the first place. So one of the primary reasons why we adopted GDP weighting for our portfolio strategy is because we had a positive long-term outlook on emerging markets. So if you do your portfolio based on a market cap weighting, your portfolios will mainly be invested in developed markets with very little exposure to emerging markets. But on the other hand, if you do GDP weighting based on the size of all the different economies in the world, your portfolio will be tilted towards countries with very large economies, such as China and India. But these are countries that don't really have very mature capital markets. But having said that, these are also markets with very exciting growth prospects. So the underlying thinking behind GDP weighting is that, even though some of these markets like China and India, they don't really have very developed capital markets right now, but in time to come, as these markets continue to open up, their equities will attract inflows that will result in an increase in the value of their stock market, which means in time to come, the size of their stock markets will be as significant as the size of their economy. And this will lead to outsized returns for investors in these exciting emerging markets. But instead of waiting for these markets to rally and then we start to buy, which probably is already too late, we buy now with the expectation that these emerging markets will generate higher returns for us in the future. So, which is why we have adopted GDP weighting inside our portfolios to get exposure to these exciting emerging markets that could potentially give us higher returns in the future. Another reason for GDP weighting is, of course, diversification. Because if you do market cap weighting, then the end result is that your portfolio is going to be highly concentrated in the US. Because US equities, they constitute more than 60% of the global stock benchmark, which is quite similar to the way Japan dominated global equity markets in the 1990s. At its peak, Japan was actually 44% of the MSCI World Index, which is the global stock benchmark. But after the bursting of its stock market bubble, this percentage actually fell dramatically to about 10%. Now, I'm not saying that the US will eventually end up like Japan. Okay, that's not what I'm saying. Okay, but when we first incepted our portfolio strategy, having 60% in a single market was not the kind of globally diversified portfolio that we had in mind. GDP weighting, on the other hand, it is a lot more diversified because it gives us an allocation that is more evenly distributed across different equity markets. And another reason why we adopted GDP weighting is because it works. We are not changing our methodology right now because GDP weighting is flawed right from the start. It is not. In fact, there is evidence that GDP weighting has outperformed market cap weighting in the past. And I have included a performance comparison between the market cap weighted MSCI AC World Index as well as the GDP weighted version. And you can see that for over 2 decades, from year 2000 to 2020, the GDP weighted index has actually produced better returns compared to the market cap weighted index. And before the massive slump in the Chinese equity market, our portfolios have also outperformed the global stock benchmarks. Now, the next question then is, if GDP weighting is so good, if it's a strategy that works, then why are we switching away from this very good strategy? Well, it's a good question. And the short answer to this question is that GDP weighting has actually lost its relevance, especially with the major changes that have taken place in the global landscape over the past few years, which I will, of course, be elaborating in my next few slides. Now, the very first reason, the primary reason why we are now switching away from GDP weighting is because we no longer have a positive view on China's long-term economic prospects. So one of the characteristics of GDP weighting is that it results in China becoming the largest and very significant overweight position in our portfolios relative to the global stock benchmark. And you can have a look at this table over here, okay, the table on the left, which shows you the top overweights in your portfolio if you implement GDP weighting in your portfolio. So China is the top of the list. And if you do GDP weighting, your portfolio will be overweight China by quite a large 15.4 percentage points. And the reason for that is because China's economy is a lot bigger compared to the value of its stock market. And similarly, if you look at the table on the right, which shows you the top underweights in your portfolio if you do GDP weighting, the US is the single largest underweight position in your portfolio. In fact, you will be massively underweight the US by a huge 37.4 percentage points. So if you can recall, in my previous slide, I say that if you do GDP weighting, your allocation to the US is around 25%. So you compare this 25% to the global stock benchmark, which is about 60% allocation to the US. So there's a huge difference between your US allocation when you do a GDP weighting versus market cap weighting. So in short, if you do GDP weighting, you are essentially overweight China in your portfolios and you are underweight the US in your portfolios. So it's essentially a bet that China will outperform the US in the long run. Well, in the past, this was a bet that we are comfortable making because we were bullish on China. China's economic rise has been remarkable. Its embrace of a free market economy has led to decades of high economic growth, and that has provided investors with lots of investment opportunities. But fast forward to today, the situation is very different, because instead of opening up its economy further, China has in fact gone in reverse. It has accelerated its shift towards a more state-controlled economy, towards a more authoritarian form of government. Its sudden policy changes over the past few years has also done permanent damage to business confidence. And on top of that, you have rising geopolitical tensions, particularly US-China tensions. And that has caused countries to reassess their economic dependence on China, and has also led to China become increasingly isolated from the rest of the world. So it's because of these recent events, which we believe is a huge negative for China's long-term economic prospects, that has actually led us to have a more bearish view on China, which also means we no longer have the same kind of belief and conviction in China as we had in the past, which means it no longer makes sense for our portfolios to continue adopting GDP weighting, because it will result in our portfolios to continue having a significant overweight position in China. And on top of that, with China no longer presenting the kind of opportunities that it once did, so where else do we go? It's actually the US equity market. The largest and the highest quality companies today are predominantly based in the US. And most of these companies are actually industry leaders with sustainable competitive advantages that will allow them to stay ahead of their competition. And one thing about US companies, especially the largest US companies today, is that over the years, they have become increasingly globalized, which means that even though they are all headquartered in the US, they don't just sell to US consumers. In fact, they sell to global markets, which means that they hold dominant positions not just in their home markets, but also in various other international markets as well. And I think big tech companies are very good examples of this trend. If you look at big tech companies, they are headquartered in the US, but they actually hold dominant positions in a lot of global industries, such as digital advertising, in the area of search engines, and cloud infrastructure as well, which is becoming a critical part of the AI revolution. Cloud infrastructure is just controlled by 3 companies today: Amazon, Microsoft, Google, and all of these are US companies. China also has their fair share of big companies, I must admit, but for Chinese companies, they are mainly focused on serving the domestic market. And when it comes to Chinese companies, any competitive advantages can easily be destroyed overnight. Entire business models can be taken apart overnight by the orders of the government, by the simple stroke of a pen, as we have witnessed over the past few years in areas like the online education sector, the internet companies, Chinese property companies are also being cracked down upon. So if you have ever invested in Chinese companies thinking that, these are market leaders in China, these are blue chip companies, can't possibly go wrong with these big Chinese companies, you will have learned a very painful lesson in the recent few years, especially if you have invested in those sectors that were subjected to very harsh government crackdowns. So all these developments in the past few years have actually reinforced our belief that the US stock market is actually a much better place to be in compared to China, especially if you're a long-term investor. And on top of that, if you think about some of the most recent technological breakthroughs, such as the AI revolution, the companies that will benefit from some of these technological advancements are primarily US companies. You just need to look at some of the leading companies in the AI space. In the market for AI chips, no prizes for guessing who's the market leader. NVIDIA is currently the undisputed #1 player. It almost looks like a monopoly to me, with more than 90% market share in this particular market. And in the market for AI models and platforms, the dominant companies are also US companies. OpenAI is currently the leading model maker in the AI space, and big tech companies also have a big presence in this market as well. So with China no longer giving us the kind of opportunities that it once did, the best stocks to own in the world today are mostly US companies. Another reason why we want to switch away from GDP weighting in favor of market cap weighting is because of our strong belief that the US equity market is going to be the place to be in for long-term investors. And on my next point, the US has a very strong advantage over the rest of the world. What kind of advantage does it have? It has a very well-developed capital markets. It has the world's largest, deepest, and the most liquid capital markets, which means that its funding landscape is very well developed. Businesses that need capital, they have efficient channels for fundraising. There is plenty of funding available for high-growth startups, and most importantly, companies that list in the US, they generally command a much higher valuation compared to a listing on another exchange. And such is the attractiveness of the US equity market that a lot of companies, a lot of foreign companies have been increasingly doing their IPOs in the US, including our own Singapore companies that have been flocking over to the US to do their IPOs. So the US right now is the go-to place for global companies to do their fundraising activities. But this hasn't always been the case, because just a couple of decades ago, London was actually the place to be for stock exchanges. But today, the US has actually overtaken London to become the global hub for equities, and its dominance over the rest of the world has only been increasing. And why is this important? Why is a well-developed capital market important? It is important. It is important for innovation. Not only do you need good scientific research for innovation, you need a well-developed capital market to turn all these good scientific research into global technology companies. And the US has a long history of doing just that. If you look over to other regions like Europe and UK, they arguably also have institutions and good universities that produce good scientific research. But one thing that they are lacking in is a well-developed capital market. Their capital markets are not as well developed as that of the US, and this is one of the reasons why Europe has been falling behind the US in terms of innovation. They have not been able to turn their scientific research into world-leading technology companies. The US has that. It currently has the best capital markets in the world, and it is an important advantage for the US because it ensures that the next big thing, the next tech success story is more likely to come from the US than it is from the rest of the world. So I just want to conclude whatever that I just shared with everyone. Our worldview right now is one where China is entering a period of structural decline, whereas the US is expected to maintain its dominance not just over China, but also over the rest of the world as well. Which also means that it is no longer in the interest of our clients to continue persisting with GDP weighting, because our portfolios will have a huge overweight in Chinese equities. So if we are switching away from GDP weighting, what would be the alternative? The alternative is actually market cap weighting. Market cap weighting will result in our portfolios being substantially invested in the US and not so much in China, which from our point of view, it's more aligned with our long-term market views. So if you look at this table over here, you will be able to find our new allocation. So this new allocation is actually based on market cap weighting with some modifications. And one of the modifications that we have done to our allocation is actually the addition of a 20% allocation to digital economy stocks. So this is a standalone component that we have retained from our previous allocation. So previously, we also have an allocation to digital economy. And in fact, we have a 10% allocation to digital economy stocks. We have kept this in our new allocation, and we have since increased the percentage allocation to 20%. And this is a reflection of our strong belief that digital economies, digital technologies are expected to drive massive disruption in the years ahead. So the rest of our portfolios is actually allocated across other major equity markets, and that includes Europe, Japan, and Asia ex Japan. We have also replaced our allocation to China and Latin America with a 5% allocation to emerging markets. Now, one thing that you'll realize about our new allocation is that our allocation to the US is only about 40%, which is much lower compared to the global stock benchmark of around 60%. The reason for that is because our allocation to digital economy already has significant exposure to the US equity market. So if you take into consideration our US exposure within our digital economy allocation, our overall portfolio exposure to the US is actually closer to 60%, which is in line with the global stock benchmark. So if you invest in our managed portfolio solutions today, you will be investing into this new allocation. Okay, at this point, I just wanted to say that, at iFAST, we generally don't advocate big changes to any investment portfolios. But in this case, the switch from GDP weighting to market cap weighting is a necessary change. It is a change that is in our clients' interest because it no longer makes sense for us to persist with a strategy that is fast losing its relevance, and it is a strategy that is no longer aligned with our long-term market views. So for our existing clients, we have already done a rebalancing of your portfolios to implement this change. So you probably have received quite a number of emails from us to inform you about this rebalancing exercise, which has already been completed for the vast majority of our clients. So don't be alarmed if you have received multiple emails from us. Those emails are related to this change that we are implementing in the portfolios. And moving forward, we will continue to review our asset allocation on a regular basis, and you can be assured that your portfolios are closely monitored by us. So with that, I end my presentation. Thank you so much for your time, and also thank you so much for your continued support for our managed portfolios.